Hello, and welcome back to the Wallfacer podcast. Today's guest is Rob Montgomery, co-founder and CEO of InfiniFi. Rob, welcome to the show.
Great to be here, Ryan. Thanks for having me. Excited to get this going.
Thank you. I mean, I kind of feel like InfiniFi came almost out of nowhere. And now I see you guys everywhere and very consistently, very good yields on Vault.FYI. So really wanted to have you on and dig more into the project and your background.
I mean, hey, man, I appreciate it. We have definitely been working for a while in silence, and we finally just exploded out in early June.
I mean, in the words of great American poet Lil Wayne, real G's move in silence like lasagna. So well said. So if my timelines are correct, I believe I just scrolling back through Twitter and stuff, you guys announced InfiniFi in February, launched at the end of May, pretty quickly crossed 10 million in TVL, and then just recently, I think late August, crossed 100 million or so in TVL. That's pretty quick growth, all things considered. I'd love to just sort of get the timeline of from February to May. What was that like for you guys? And then from May to now, what's that been?
February to May was a constant spread. Product development is always a massive work of love. And I mean, when we announced, we had a decent amount of it done, but we still had to go through the audits. We had to, make sure that we had people who were interested in using the protocol. We had to line up all the little pieces, get everything in place, and then launch pretty quickly. Those conversations we'd had ahead of launch propelled us past 10, and that started helping us grab attention from across the industry. I would say that it's honestly been even faster paced since we launched. I thought it would, be a little slow. No, it's gotten faster. And we've just been talking to pretty much everyone saying, hey, you're using Aave right now. Come use us for your liquid side. Or, hey, you're using USDE right now. We're partnered with Athena. Come use us for your duration side. We'll give you a higher yield with pretty similar exposure. And it's been working. We're getting retail interest. We're getting, very solid reception of our points program. We're also getting protocol interest with, people I think we just announced our deployment with RE. They've got, I think, a little over 2 million in my system right now. And we just announced that today. We are starting to recruit even more and more protocols to begin using us as their backing. And we got a few asset managers who are going to be going live here pretty soon. So it's been really, really cool seeing it grow. It definitely has not gotten less intensive, though.
Well, I imagine from here, it's just kind of more intensity all the way up. But
yeah. We literally crossed 100 million last week, and we're already nearly at 120. It's
nice.
Cool.
Yeah. So you kind of actually touched on the next thing I was curious about, which is I'm very curious about the composition of capital that you have in the protocol today. You mentioned that you have asset managers, protocols, retail. So it seems like you've got the whole kind of spectrum. I mean, how is that? Like, where did you see the first capital interest come from? And then more recently, what has that looked like for you guys?
So where did we get those first intros? Investors primarily. When we were really starting out, it was like, hey, you should be talking to these people, or you should be talking to those people. And we'd end up talking to, various notable funds throughout the space, discussing, hey, we can increase your baseline returns by this much, getting their interest. As we moved on, I mean, we already knew the guys at Doja. I guess that would be our biggest KOL that we're friends with. He just started talking about us. He's one of our advisors now, but even before he was an advisor, we ran into him in Denver, and he liked what we were doing. And thought, yeah, this is really cool. This mirrors some of my own ideas. We just started being friends and discussing all the cool tech we were building, the direction we were taking it. As we've gotten more mature, new friendships have come from protocols we're partnered with. New friendships have come from, people we already are friends with, introducing us to their friends. We see a decent amount of whales acting that way as well, especially since we started implementing our whale outreach program. That has been very successful in increasing deposit size across them and getting more interest from those whale groups. And I would say that really that hands-on, for those of you who don't understand, our whale outreach is if you meet a certain threshold in InfiniFi, we give you a special pop-up that it's like, hey, you're a VIP. Here's your concierge. Any questions you have, talk to her. That's our head of growth, mind you. And it's worked great. People love that we actually, care about what they have to say since they're trusting us with huge amounts of money.
Yeah. I mean, it seems like such a low-hanging fruit, but you actually don't hear of many DeFi protocols doing something like that. So sometimes those low-hanging fruits do exist.
That has been the feedback we've gotten, and it surprised me because it's such an easy thing to do. All you have to do is like, hey, you're an important customer to me. You're giving me significant amounts of money. How can I better improve your experience? It's not like there's that many of them.
Yeah, sometimes it really is that simple. But interesting. You mentioned Steven and the dojo. They've actually been a great source of traffic for us as well. Great folks over there. So shout out to them.
They are incredible.
Yeah.
We have so thoroughly enjoyed working with them. Really, some of the best feedback I think I've gotten has been from people in Dojo saying, hey, we'd really like this, and us going out and implementing it, or, unimplementing it in some cases. It's probably one of the highest concentrations of our core customer base in the sector, which is really, it's those people who know how to use these systems, how to, run complex strategies on them, who are deep DeFi exposure and have a variety of different things that they use InfiniFi for. We've gotten a lot more insight into, why do people like us just from talking to people in there.
So I realize for some people listening, they might have no idea what InfiniFi is. So maybe
Yes.
that's, a great place to go. So what is InfiniFi?
Yeah, we're an automated on-chain, I hesitate to say banking system, but yeah, it replicates the function of a traditional banking system. What we do is we employ a borrow short, lend long strategy where we're taking the majority of our liquid capital and 75% to be precise. We're deploying it into a laddered portfolio of duration assets, mostly SUSDE, FX Save, and then a lot of Pendle PTs. Since we have more money in a higher yielding asset class, we end up generating a higher marginal return than we would otherwise if we were just putting this into, say, Morpho. And since we're generating a higher marginal return, we can distribute that across our depositors such that our liquid depositors are making a higher rate of return than they would if they were in liquid assets. And our duration depositors are making a higher rate of return than if they just deposited SUSDE or the direct PTs themselves. We improve yields on everything. Long story short.
Makes total sense. The piece that I'd like to just dig into quickly is I understand, and I think probably listeners will understand really intuitively. Okay, so normally, say I deposit into an Aave or a Morpho, I am theoretically taking a lower rate than I otherwise could because there's almost like a liquidity premium inherently built into a lot of these things. I can withdraw my money at any time. What you're saying is, hey, there are people who are willing to lock their funds up, willing to take that duration risk. And as a result, they should be paid more.
Exactly.
Right. Is that kind of a fair summary of the thesis behind a lot of what you do?
Very much so. There's also people who are willing to have, okay, most of the time I want my money back. I'll be able to get it immediately. Sometimes people will have all withdrawn at once and I'll just have to go sell in the secondary like I do with STETH. We already know that class user exists because STETH has users. So it was very straightforward to say, we know this user's here. We're going to give them higher yields. We're going to give them the ability to get, mostly liquid exposure to Pendle and Athena. And they're going to get a higher rate, but with that trade-off, the same one they take on ST.
Yeah, and can you actually break down the piece where the user who is taking on duration, and so I think for the listeners, the max that someone can lock their funds is 13 weeks right now, I believe. So if you're someone who is locking for 13 weeks, how is it that that user is getting a higher yield than they otherwise would? What's the underlying mechanic that's happening?
Yeah. So what we're doing here is we take their money and we put it into a set of assets, a laddered portfolio, which really the intent that they express by locking a certain amount of money into a certain duration allows us to form. But we distribute their capital across a bunch of different PTs and Athena and FX Save. And we then take 75% of our liquid depositors' capital and we distribute it according to the same ladder. Now, our liquid depositors don't expect to get the same rate they would get from directly buying a PT, since then they're truly locked. They're okay with a lower rate than the PT is actually earning because they have that liquid optionality they wouldn't have if they just directly deposited to a PT. And so what ends up happening is we can take a little bit of the money of the interest that their money is making, and we can give it to the duration depositor who said, okay, I will lock, and I'll take on that first loss risk, and I'll be that junior tranche. And we can pay them a premium for taking on that additional risk, that duration risk even. And the other side, the liquid depositor, doesn't feel cheated because they're still getting a higher rate of return than they would if they just went with a traditionally fully liquid position.
Maybe the analogy here that will resonate with people is to almost think of this as kind of tranching to an extent, where instead of it being junior and senior necessarily, it's kind of like, there's duration and liquid, where the duration people are getting paid more because they're willing to take on that, max exposure of say 13 weeks. And the liquid people are kind of like the senior in this case, where they have the ability to pull the majority of their funds or all of their funds kind of at any moment, theoretically.
Yeah, it's a maturity approach. The interesting thing here is like, this is why I use banking as an example. This is basically how banking traditionally works. When you think about the concept of borrow short, lend long, when you think about the idea that, if I'm a bank and I'm investing in a piece of real estate, well, I'm the senior tranche, and the guy at the equity on the other side, he's the junior tranche. So we kind of combine those two operations here to really to form a continuous maturity tranching system that does distribute the yield based on how much optionality you have on exiting the position.
On sort of what actually the composition of that portfolio is. One of the things I find kind of most interesting about InfiniFi is actually how you choose what goes into that duration portfolio, and I guess the liquid portfolio as well. So be curious if you could kind of talk us through how that selection happens today, and then also as you move towards more of a governance type of system, what that may look like in the future.
So it's an optimization problem, because what you're trying to do is you're trying to allocate the most amount of capital to the highest yielding assets with the least amount of risk. It's actually a very complex optimization problem. So let's start with our parameters, our constraints, I should say. We want to make sure that when we allocate capital, that we are respecting the shape of our ladder. And how do we, or skewing short even, how do we know what our upper bounds on duration are? Well, let's say that on our duration side, 25% of our depositors in our duration set have said, hey, I'm okay with 13-week duration. Well, we now know that we can have capital allocated to 13-week assets up to 25% of our total size. If we go over 20, we are now creating a much bigger duration gap than we would otherwise have. We're basically ignoring the will of the public, which we don't want to do. We want to look at what the crowd is telling us, the wisdom of the crowds, and try to match it as best we can. So we have rules that say you must respect, this amount of capital can be allocated here, this amount of capital can be allocated here. Obviously, if we skew short, like if we don't have to allocate 25% to 13-week, we can allocate 10 and then allocate more to a short duration asset, that's fine. But we do have those upper bounds. We also, as the team, we implement caps on these assets based on what ourselves and our risk council think that their risk parameters are. That gives us a decent amount of control at the moment, though we are in the future going to be lessening that dramatically as we move into a more aggressive governance-driven system. Then we take in user votes. And the user votes right now, they inform us as to, hey, what should we be allocating here? What should we be allocating there? Obviously, like I said, those caps have a decent amount of power over how the system is allocated at the moment. But the votes are basically considered in the context of the caps, and then our system rebalances itself according to those two different parameters while also respecting that upper bound set. So that's how it works right now. It's looking at the security parameters, it's looking at caps, and it's looking at user votes as expressed by duration depositors who are given the permission to vote. What we've found in our first iteration of the system is that the voting isn't great. The voting is acceptable, but you end up having a lot more allocations to things that are way higher risk than really people should be allocating to, people just voting for points and not really actually putting thought into it. And so one of the major things that we're trying to do once we move toward a token, which I will neither confirm nor deny that there is any planned airdrop for, that would be questionable. But as we move toward a token, which I do intend to have at some point in the near future, I want that token to assist in driving better voting outcomes. And my original thoughts on token were, hey, I really like VE Pendle. It's a good system. It allows you to, skew returns toward people based on how much VE Pendle they hold. But I've been thinking a lot lately, and I guess this is some alpha. I can't guarantee this will happen, but I'll talk about it because I think it's really cool.
Please.
Yeah, that's a neat toy, but it doesn't actually really serve the protocol. VE Pendle, I don't think really serves. Well, it serves Pendle to an extent that, bribes are good, and that kind of works. It works in the same way Curve does, but it's not the best solution to the problem. It's not the best optimization. It works for them because they have fee generation. And then the extra skew is a bonus. What I think would work better for us is probably the best optimization solver I've ever seen in DeFi, and that is Velodrome Aerodrome VE33, which, there are parts of it I don't fully agree with. Like, I don't know about an infinite inflation. There's a lot of considerations here, early days. But if you look at what Aerodrome does, or what Velodrome does, what it is it's actually a very good optimization algorithm. It's searching for the local maxima across a very broad set of problems. And what it's trying to solve is, hey, how do we allocate LP capital efficiently across a bunch of different DEX pools to get the most fees at the lowest slippage? And how do we encourage people to pick the right pools? How do we drive an efficient optimization of that? The way they do that is that with the voters are thinking, hey, what's going to generate the most fees this week? Since the voters, when they vote emissions onto a pool, they're getting the fees that pool generates. So they are voting and collecting as well as the bribes. And then the LPs show up and allocate capital where they're going to get the most emissions. So it's a two-party system where either party can make their bets and the other will react accordingly. And from that, basically ping-ponging off each other, the system arrives at what's actually a pretty good optimization solution every week, which is impressive. That's a crowdsourced optimization. That's not an algorithmic one, which is generally speaking the best type of solution because these are highly variant systems. There's a lot of alpha that, a single point optimization algorithm is not going to have. But if you crowdsource it, well, everyone who's participating has their own alpha and their own outlook, and the Gestalt solution is generally actually pretty close to the true optimum. So if you implement that instead of a volume basis, which is what Velodrome is designed for, if you implement that on a, say, TVL basis, where now you're trying to optimize for a combination of, hey, I want the highest yields with the least risk, okay? Maybe you make people who are doing the allocation put up a stake that gets completely zapped out of existence in the case of losses. And now you can start designing around, hey, what's the highest yielding set here while remaining within the global constraints of the system? Because if I step outside those global constraints, I'm going to not get as much return because, well, the system won't allocate to it since it breaks an invariant. And you end up being able to completely crowdsource a lot of the curation, which I love the idea of. Eventually, we'll allow for the community to actually decide what assets should be on here, but that's going to be a long time because that creates a very big problem with tragedy of the commons. And, I have $100 million. I'm just going to vote to give myself all the money. Sorry, losers. So you can't do that one very easily, but I think you can crowdsource and heavily optimize the allocation if you design the tokenomics right.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
Very interesting. And I think it's clear both from what you've just said and also kind of through having read through the working white paper that this system that you're working towards has, or I should say, kind of envisions several roles within the allocation system of what you guys do ultimately with capital that sits within the protocol. I think what I found actually most interesting about the current setup of how sort of these decisions are made, even though there may be a lot of apathy amongst the voters, is that the voting today happens amongst not, some governance token holder, but rather through the people who are actually in the protocol, right, is my kind of understanding there. I know Lido had a proposal around this at some point where STETH holders would have a role in their governance as well, and not just LDO holders. So I also find that to be kind of a really interesting thing where the people who have theoretically 100% to lose, rather than just governance token holders, really should have some role and some say in the governance of the system that they're contributing their capital to.
Absolutely. I think that's one of the biggest flaws in traditional banking is that the people who are in charge of your money, well, they have all the incentive in the world to go high on risk and no incentive to take care of your capital. Yeah. I mean, at the end of the day, if I'm Lehman and I'm a banker there, okay, subprime mortgages exist. My buddy down the hall is investing in them, and he's going to outperform me if I don't invest in them. I'll get fired. I'll lose my job. I won't have my livelihood. If I do invest in them and I outperform him because I get even riskier, I get a bonus. I get a promotion. I got a lake house. I'm living good. It all goes tits up and everyone's money gets completely lost. Or steps in and takes care of it. Not my problem. I go down the street. I get a new job. Talk about all the returns I pushed into my old one. It's a prisoner's dilemma, and people are forced to play it. I can't say that, I think banks are evil, but I don't necessarily think it's the fault of the bankers. I think it's just how the system is built. But if you put the people who have the money to lose in charge of things, you end up with much more incentive-aligned allocation.
Yeah, and I think there is a probably stability that comes from that, perhaps less risk seeking in people who are maybe a little bit more judicious, but also we are in crypto, so maybe it's even more risk seeking, TBD.
I mean, that's where my curation has to come in. Myself, the team, the risk council. We're pretty careful what we put in there. If it looks like it might have a decent chance of, going belly up, and I won't name names, but you can look at what PTs we have, and you can look at what PTs we don't have, and you can probably make some, draw some conclusions. Then we just don't list it. And I mean, hey, there's stuff that I want to list that I haven't been able to yet. Like I like the stuff that USDAI has with their T-bill back version. I like stuff Cap has, but Cap's like out of range. It's 130 day or something. I can't touch that. I'm a 90-day guy. Eventually I'll have it. But there's definitely stuff out there that's really good yield, but I just won't touch it because it's got too strong of a risk of losing everything.
Yeah, I mean, I would love to. I've got 2 jumping off points from there. So let me bookmark a question about duration assets. Come back to risk, like to the extent that I don't think I read anything about this in your on your docs, but I am curious, kind of what the risk selection process is today. How are you and the team choosing what gets allocated to, what gets not? Like, what is even in the selection and voting criteria?
So we have people on the team who have background in banking, a little bit of a background in underwriting, but not enough that we feel confident relying solely on them. What we do instead is we use the team's input to inform, the first pass. Okay, is this just garbage? Do we even need to bother considering this? Then we take the asset to a group of hedge funds and LPs, also Dojo and a few others who are, very knowledgeable in the DeFi space and have extremely good insights on diligence. And we ask them, we say, hey, you're a hedge fund. You are one of our friends. Have you done diligence on this asset? Would you put your LP's money into this asset? And if the answer is no, we won't touch it. And if the answer is yes, we will. And a lot of times we'll, inform what the caps are from their input, advance the caps as, the lending grows. But it's a pretty black and white process. If somebody says no, like a hard no, that asset's off the table, because these are people who they are trusting us and we trust their diligence process, having seen how they applied it to us. So if they trust another asset, we consider that the gold standard and we're willing to allocate to it. Otherwise, it's not worth the risk until we've hired someone who has a full-time job as a DeFi underwriter. Then maybe we consider in-housing a bit. But I really like outsourcing as much as I can, getting as much external input on safety as I possibly can, because this is a lot of money that people have trusted InfiniFi to take care of. Now, while the system itself may be automated, the selection of assets for it is not. And we need to be very careful with who we let into the system. We need to consider what their audits are. We need to consider how transparent their system is. If it's some guy in a multi-sig, that's probably not even making it past the process. If it is, it's getting maybe $1 million, $2 million cap. If it's a fully automated system that's on-chain, has full verification, and has been operating seamlessly for months, if not years, nearly uncapped, full send, throw as much money at it as we can. Stuff like Athena.
Yes. Yeah. I mean, as a framework, checks out. I guess my other question that I kind of tried to bookmark earlier and feels the question basically comes down to duration assets historically in crypto have struggled. I think people enjoy the constant liquidity that is available to them. I think you also mentioned Cap having even longer duration products than you guys. What do you think has changed to enable both you guys to be able to attract people to these long duration assets, and maybe more broadly to get people comfortable with having their funds locked up for some period?
I would say the industry's growing up. That would be my general take, is people got used to the idea of locking with things like Curve and Velo and VE systems,
Sure.
into 22. That helped them to feel more comfortable about it, because they saw they could make great returns on that stuff. As the point wars began, the yields on Pendle were so good, you could not ignore them. I remember I made 40% APR on EtherFi. Mm-hmm. Back during the restaking frenzy of early 24. And that, I think, helped get a lot of people over the hump. is like, oh, this is safe. There's a lot of money in it. Other people I trust are talking about it. I just got to do it. And as this, I mean, Athena as well, their 1 week cooldown made people feel a lot safer about even just 1 week. And if you can get over 1 week, it's not that hard to get over 4. If you can get over 4, it's not that hard to get over 8. It's just been a gradual dragging out of people's risk tolerances. Also, as funds have gotten more into the space and hedge funds have become more established, they've gotten to drag out their redemption periods to longer and longer durations, which means they can deploy money for longer and longer periods. So the institutionalization of the space has also definitely played a role, along with just points mania allowing us to finally start to construct a yield curve. The Pendle trading especially has really been the tip of the spear on this sort of thing. And that has definitely opened up duration appetite in a way that we never saw, 4 years ago. I've got, I want to say, somewhere around 50 million in duration deposits. It's a lot more than I had expected. I had expected probably a 1-to-8 ratio. We're closer to like 4-to-6, I believe, which is far higher than I thought there was appetite for. And a decent amount of that is 13-week max locked. There is more demand than I'd expected for long-dated stuff in this industry. And my best guess is people are just, they understand what this is. They like the PTs, they trust the PTs, and they just want that high yield. So it has certainly surprised and impressed me, but it's a logical progression. Most of finance is built on duration stuff. As the industry matures, it seems inevitable that our yield curve becomes bigger and better and stronger and longer. Right now, we cap out at about 3 months. I mean, Cap's pushing the envelope on that. Like I said, their PT is like 6 months, which is wild. Want to touch it, but can't because we're still at 90 days. Might change that later if I see more going that long dated. But I think at some point we do start to stretch beyond 3 months. Right now, the last time I ran an analysis, I'll give you some context. 3 months beyond it, you actually see a negative sloping yield curve. Beyond a quarter period, you would think that your average APR would increase. Like a yield curve, typically longer duration equals longer return. When it starts to slope down, that's called an inverted yield curve. And actually beyond 3 months, crypto's yield curve is inverted. Probably because that's an eternity in this industry. And it's very hard to predict what's going to happen, even 3 months out, much less 6. So I think that's where people's appetite starts to stop, but that's also where TradFi begins. And as we see crypto and TradFi, kind of coalescing, starting to marry each other, basically, you're going to see TradFi picking up where the crypto appetite ends, and those two just segment right into each other.
That would be a beautiful marriage and handoff there. And I definitely want to ask how you guys are thinking about TradFi. At the same time, I mean, besides InfiniFi, probably the protocol we've mentioned the most in this recording so far has been Pendle. And, I would say Pendle just seems so key to everything that you do, right? I think it is about 50 million of the duration exposure that you guys have today. Obviously, a popular use case for your LP shares is people that move them onto Pendle with IUSD, SIUSD. Talk to me a bit about how, could InfiniFi work today without Pendle? And what is that symbiotic relationship between how you guys utilize Pendle and where you are today?
We definitely would not be able to exist without Pendle. They're the source of the majority of our assets beyond 1 week. In fact, right now, I think they're the source of all of our assets beyond 1 week. They have engineered something quite impressive, and we are very much in a symbiotic relationship with them. We allow users who ordinarily would deposit directly to PTs to deposit to our lock tranche. Those users get higher yields as a result, and they get auto rollovers too. So not only are you getting an automated PT experience, you're actually ending up with more money at the end of that experience than if you had directly deposited to Pendle because of how our tranching system works. On the liquid side, we're bringing capital into Pendle that ordinarily wouldn't be there because those users, they want their optionality. They want to be able to leave if they need their capital back. So typically they would not deposit into PTs. Pendle loves that they can get access to these users. It's an entirely new segment of the market they haven't been able to tap, and we open it up for them. So not only are we, symbiotically getting their users to deposit into us, we are also in the process of getting their users to deposit into us and basically proxy through us. We're increasing their TVL. So it ends up being a very mutualistic relationship. They point people toward us, we point those people back into them, and we drag along a bunch of users who never really would have deposited Pendle otherwise.
Yeah, and actually just segueing off of that, before InfiniFi, if I'm correct, you actually had kind of founded another company that maybe had Pendle-like characteristics.
Oh, it was
sort
a
of
competitor.
It was a competitor to Pendle.
I
Yeah,
at one point told Tia, and I thought, that my system would win and his would lose, and no, I was wrong. His system won. He did end up implementing order books, which is something I told him he needed, though he probably already had plans to far ahead of that. That was called Resonate, and it was a good idea, but it was not done in a way that was crypto native. We were coming at it with NFTs as the principal packages. And the nice thing about Pendle is even if you do need to leave, you still can. You can exit a PT early. You'll lose a decent amount of money doing that, right? You're going to get hit with slippage. You're going to get hit with early exit fees effectively, but you can leave. Resonate didn't have that. Resonate was a hard lock. And because of that, Resonate didn't work. People didn't want a hard lock. They wanted the ability to exit those positions early. Pendle provided that. And so in that competition, Pendle won. My attitude after that was, okay, I understand how this works. I understand what the people want. I'm going to give them what they want.
Yeah, that was my kind of follow-up question, which is, what was it that you learned from Revest/Resonate that carried forward? And it basically sounds like
customers. Serve a genuine need.
Even simpler, yeah.
Give the people what they want.
One question I was kind of thinking of is, why haven't more yield aggregators or folks that could be your competitors implemented some sort of laddering mechanism like this?
Why haven't more yield aggregators? I think it's a very different way of thinking than they are used to, than their users are used to. And if I'm running a liquid farming system, I'm just fine with it as it is. If I'm running Beefy, I'm quite happy. If I'm running Urine, I'm quite happy with how things go. And they've got their PMF and they haven't seen the need to change it. Kind of like Aave hasn't built this. Well, why would Aave build this? Their current products work great. They're making a lot of money off them. They don't know if this is going to work or not. They're not going to pour resources into it to find out if it does work. And by the time it's working, why would they try to compete with me when they can partner with me? I benefit them. And because I have a very strong network effect, thanks to my reserve ratio, it'd be extremely hard to catch up. It's, I think the term is the innovator's dilemma. You don't know what's going to work, so you don't, pour resources into it unless you know it's going to work. By the time you realize it's going to work, it's already working. This was a problem that not a lot of people were thinking about because not a lot of people were working with duration assets to begin with. Most of the yield aggregators have always been working with liquid positions and just compounding on them. I was trying to solve this because the guys at Into the Block, now Centaura, asked me, hey, can you make we like Resonate, it's a cool idea, but we can't touch it because it's a liquid. Can you make it more liquid? And I went out and I tried to solve it, and almost by accident, I stumbled upon a first principles approach to the classical problem of banking. How do you borrow short, lend long? And it turned out that if you eliminate a bunch of the inefficiencies in the traditional systems, you can pass the returns direct to the depositors and increase their returns. So that's something that was kind of hiding in the banking system, but the banks charge so much that you don't realize that it's even there. And so I was thinking about this in a very different way. I was thinking about it at a perfect time because, duration stuff had just started happening in early 24 when I came up with this idea. It had just really burst on the market, but I'd been working in a dead end for a while. So I was used to the markets and I knew what they were. And somebody asked me the right question at the right time, and I found the secret sauce. Pretty simple.
Nice. Yeah, you actually mentioned the concept of kind of a network effect within InfiniFi coming as a result of your reserve ratio. Can you explain that a bit more and actually maybe where you see some of that defensibility or those moats?
Yeah. So when I think about how we are able to defend ourselves, it primarily relies upon just the amount of information that we get from our depositors. Every single duration depositor gives us another data point, another piece of high fidelity data. And the more of those that we aggregate, the better understanding of our user base that we have, the better understanding of the general public demand for duration across DeFi that we possess. So we can act on that information. We can begin to lower our reserve ratios because we not only have, better fidelity data, we have more users, which means that all of them trying to leave at once is less likely, which means we can run the system hotter. We can deploy more and more money to duration assets than if we were, just starting out. That means that our yields will always be higher than someone who is just starting out. And what that means is that we end up making a net positive return on pretty much everything compared to somebody who's just spinning up their system. You won't use them because their returns are lower. That's the beauty of it. So the more users I have, the higher my returns can become.
They're coming back to something we touched on earlier, is the role RWAs will eventually potentially play within the system. I see you smiling. And this idea kind of a tokenizer that you've talked about in a few of your different documents and such. Talk to me what that future looks like where RWAs play a bigger role in the system.
Absolutely. So what we're angling for here is applying the same concepts behind InfiniFi to TradFi assets. InfiniFi increases rates of return on any duration asset you plug into it because we have that additional liquid capital coming in there and, providing extra oomph to it, buying more of the asset and then skewing the returns toward the duration depositor. That works great on Pendle, and that also works great on tokenized credit funds. It works great on pretty much any tokenized TradFi asset in existence. But what I'm really drilling down into is credit funds because they have high rates of return that are well suited for DeFi. They have already begun to come on through different tokenizers, but currently their rates of return, because the tokenizers are taking 1 to 2% management, their rates of return are lower on-chain than they are off-chain. So there's no reason for capital to come on-chain, right? Unless they want to run pretty high-risk loops on Morpho or Euler. That's fine, but not a lot of that capital necessarily wants to have to deal with the operational overhead of highly leveraged loops. It's their first time in DeFi, and you're just asking them to, set up a 5x leverage. Kind of a big ask. What we can offer them instead is you deposit into InfiniFi, and we buy the asset that you typically would be holding on your books. Say it's ACRED or one of the Fidelity credit ETFs. And so it's yielding, off-chain 11%. Because of the tokenizer, it's now yielding 10 on-chain. Well, we run it through InfiniFi, and now it's yielding 13 on-chain. So by depositing through us instead of depositing the raw asset, you end up actually making a positive spread over what you would get off-chain. And that is a reason for you to finally use tokenizers at scale. That is a reason for you to finally bring your assets on-chain. And that is the reason that TradFi finally starts to care about on-chain financial products, because they actually are making a higher rate of return without a great deal of operational complexity. They just drop the money in and they walk away. That's what they want. And we provide that.
Yeah, well said in that I do think with a lot of these products today, and this is starting to change, like with some of these, recent, I think Gauntlet and Falcon X did something with Apollo maybe, and just like, they're bringing more DeFi creativity to some of these. But I will completely agree that historically, the value proposition for just like the tokenized Apollo or tokenized Hamilton Lane funds in the past was pretty weak. I mean, compared to general DeFi stuff, trading off the liquidity for illiquidity, they weren't very compelling offerings. And the solution that you're sort of laying out here is, how does InfiniFi, with the least amount of overhead for the issuer, turn this product into something that crypto people may find more compelling and can do things within DeFi with, right? Because that's kind of been the other challenge historically, is that these things are KYC, they require these different restrictions, and thus you can't actually do anything with the assets. So is that something that you still see as a hurdle to get past, or how do you envision some of that?
Not particularly. The KYC element of it is most of these people who would be wanting to bring on chain are already used to KYC. So as long as you're able to source the liquid capital without having to jump through those hoops, it makes it very easy. And based on our evaluations of the setups, mind you, these are early, but based on our evaluations as they stand, we should be able to just use the native capital that we already hold, consider a loan. And that facilitation means that this is an extremely straightforward process. You deposit as you would, and we give you a higher rate of return. We segregate your capital, of course. That is a slight difference. It has to be segregated. Can't be in the same tranche as everything else. But that's a technical problem, and for our users, it's completely seamless.
Yeah, and I think you're also potentially laying out the case where, again, in the past, I think there hasn't really been a great incentive for people to do KYC on chain because the yields weren't better. And if they were, it required locking your funds up for like 3 years in some private credit fund or something. And I think what you're saying is, actually, maybe we can offer you a better yield on some of these things in exchange for sharing your identity with this issuer or whatever the case may be.
Pretty much. That's the angle, is we can offer you a superior return over the TradFi world. And I'm not so interested in bringing crypto people into TradFi. I'm interested in bringing TradFi people into crypto. That's my angle.
Great. Well, as we're kind of coming up on the end here, one very simple question actually that I didn't ask, and maybe I should know, is where within the flow today or in the future do you envision InfiniFi actually taking a cut of sort of the excess interest generated.
See, I love that. No one's actually realized that we already are. Have been since day one, been taking 10% performance. That's why it says net interest on the front end. That number you see there on our front end, it's usually between 14 and 16%. Athena's a little low this week, so I think it's down like 1% or so. But that number is reflective of us already having taken our cut. And the numbers that you see, we've been taking 10% the entire time. We're making $1 million a year right now.
And that's just on all performance across the board or great. Okay.
All
Yeah,
across the board, just 10% performance.
Great.
Because we're generating a marginal profit to people, we can take a fee and nobody cares because they're still making more money.
Yeah.
That's the wonderful thing about this system is like people get upset about fees when they're losing money. And you should never design a system that makes people make less money than they would. But if you're generating them a net return, 10% performance is the standard.
Well, before I kind of come to my closing question, I'm curious, what have I not asked you today that you'd like to share about InfiniFi or that you're excited about or other topics you'd like to take on?
Well, I would say that I anticipate yields continuing to go up. I'll leave us with that. There are certain things that we have not been able to tap into that we are going to be able to tap into here in the near future, such as Morpho, once they finally release their V2. And so those numbers, they're going to keep getting higher. So definitely want to tap on that. Yes. Get in ahead of the 26th.
All right. I'll be sure to put this podcast out very fast then.
Get in ahead of the 26th. Nice big J curve.
Great. All right. Well, then my last question is looking ahead for the next, let's say 12 to 18 months, 6 months, 12 months, whatever range you feel best about. What metrics beyond TVL growth do you think will most indicate InfiniFi's success?
TradFi native TVL growth.
Nice.
Like that's almost a binary, right? I get that first deal. I'm in talks with one of the tokenizers right now, one of the funds. I won't say who, but we're working toward that. And we get that thing done. It's a straight shot. So that's all we need, right? DeFi is interesting. I think we're going to get to $1 billion here in the next 6 months or so. But compared to the TradFi angle, once I prove that system works, $1 billion is small. $100 billion is still small. That can turn very easily into multiple hundreds of billions to trillions, just because of the size of capital in wealth management right now that are looking for a way to get higher yields and would very much like to do so in a pretty boring and relatively straightforward way. They haven't found it yet. That's why they're busy buying houses, but I want to offer it to them. And once I get my first deal done, I can get a lot more done.
Rob, thanks for all the time today. Where can people learn more about you, learn more about InfiniFi? Where do you want to direct them to?
Come to InfiniFi.xyz. That's
Awesome.
where you should go first. If you want to come listen to me ramble, Robin99X.
Awesome. All right, Rob, thanks for the time.
Thanks so much, Ryan. Great chatting with y'all. Have a nice day.
Talk to you soon.